Hello, fellow rebel capitalists. What a roller coaster ride today was in the stock market. Wow. If you needed an adrenaline rush, you didn't have to go bungee jumping or skydiving today. Just watch the stock market. My goodness gracious. We have not seen this type of volatility since 2008. So let's dive into the market summary and go into some takeaways that they're not talking about in the mainstream media. First off, an article from CNBC. Title: Stocks mount stunning comeback on Monday with Dow closing in the green after earlier 1,000 point loss. I think it was actually 1,100. So NASDAQ Composite Index turned positive after being down as much as 4.9% earlier in the session. The Dow rallied after being down 1,115 points at one point. The S&P 500 closed in the green after briefly hitting a correction earlier in the session, falling more than 10% from its January 3rd close. Monday marked one of the best market comebacks in a long time. Yeah. I would call it epic volatility. I don't know that I'd frame it the best market comeback. And we'll get into a chart in a second. And I know I've got Patrick Ceresna that's going to be doing a live stream on Rebel Capitalist Pro here in about 3 hours. So I actually might hop on there and ask him about the charts and what his read is from a technical analysis standpoint, because I think the chart, I'm not really a chartist, but from what I know of technical analysis and candlestick charting, there's some interesting stuff going on as far as this, this candlestick looks like today and the trading volume. Let's get back to the article here. Monday marked one of the best market comebacks in a long time. The session was the first time since the aftermath of the GFC in 2008 that the NASDAQ composite had been down more than 4%. The session closed up for the Dow, which was down 3.25% at its low. It was the biggest intraday comeback since. Oh, okay. Well, I was just sorry about the title there. I didn't mean for that to be clickbait. I was reading the NASDAQ. I thought it was the Dow that had the biggest comeback or most volatility since 2008. So for the Dow, that was biggest intraday comeback since wild trading of March of 2020. The recent pullback in risk assets appears overdone, and a combination of technical indicators approaching oversold territory and sentiment turning bearish suggests we could be in the final stages of this correction. Yeah, I mean, you could see a pullback here. Again, what we were talking about in earlier live streams today, I think it has a lot to do with what the Fed does or says, or maybe doesn't say on Wednesday. We've got to pay very close attention to that. While the market struggles to digest the rotation forced on it by rising rates, we expect the earnings season to reassure, and worst case scenario, could see a return of the Fed put. I specifically highlighted this paragraph because I wanted to point out that so many of the market participants, even the pros, are saying, yeah, it's sure we have a market downturn, sure they're raising rates, sure they're doing this, blah, 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 blah. But at the end of the day, the Fed's going to come in and save the day with the Fed put. I'm not so sure, guys. I think the Fed could want asset prices to go down in an orderly fashion, like we were saying earlier, to try to tame inflation, number one. Number two, if they have a disorderly downturn, I don't know that they can just turn on the gas again, because let's not forget there's an inflationary fire burning from the standpoint of the CPI going up. And this trader, this professional, I don't know how old this gentleman is or gal. but maybe they haven't lived through a period of inflation, and they're not thinking through the fact this time it could be different. We'll have to see what the CPI does heading into the future. But saying that there's a Fed put and just looking back on recent history and say, well, the Fed will come to the rescue. Yeah, that's a whole different ballgame. You're talking about when we have disinflation compared to, or when we have the CPI at, let's say, 1% compared to the CPI at 7%. Different ballgame altogether. And I tweeted out a meme that I saw on my feed that I think illustrates this point well. Let's go over to my Twitter feed and I'll show you guys. Oh yeah, I just wanted to make sure I had the right view. Here you go. This pretty much sums it up. So you got two options: tapering, then stonks crash, or no tapering, no interest rate hikes, no, back to QE, and we get Venezuela, as in Venezuela. So, I mean, this is taking it to an extreme, but I think it visually illustrates the predicament the Fed could be in and the government very quickly. But again, and then so it becomes a political question, because if it's just the Fed, you can sit there and say, oh, well, the Fed doesn't care about this. The Fed doesn't care about inflation. The Fed just wants to prop up the market. I don't know. They're going to be getting a call from Jerome Powell, and he's going to be pissed if inflation continues to rise. Or you could say, well, the Fed doesn't care about the market. The Fed only cares about inflation. I don't know about that one either, because that's not what we've seen in the past, where the Fed's like, market's down 20% in 2 days. Whatevs. Oh, look, a squirrel. I haven't seen them do that lately when the market is down in a disorderly fashion. So we will have to wait and see. Again, I think what they're hoping for is the market absorbs this. They're able to talk the market off a cliff Wednesday. They're able to stick the landing, so to speak, and they're able to gradually bring the market down, and that eases the inflationary pressure, starts to bring down the CPI, so they're not getting that phone call from Biden saying, hey, fix this ASAP or there's no chance that I'm getting elected. This is a very, this is like the ending of a Mission Impossible movie, where you have all this drama and suspense, and you just don't know how it's going to end or what's going to happen next. This is like the best macro Mission Impossible movie of all time. But I want to go back to 2018 for a moment. Actually, let me go back to the article before I get too far sidetracked here. So the recent pullback in Fed put, I wanted to discuss that. Check, we got it. Investors begin, and I'm back to the CNBC article here. Investors began Monday's session dumping tech shares, as they have all month, on fears Federal Reserve would soon aggressively tighten policy. However, those shares rebounded as the day went on, with Meta, or Beta, as I like to call it, Amazon, and Microsoft closing higher. Remember, guys, if you were on the last live stream, what was I saying about Bitcoin? That we saw that divergence where once the future expectations for rate hikes started to decrease midday today, it went from 4 rate hikes down to like 3.9, down to 3.8. It started to go down. Then as soon as it did that, Bitcoin price started to go up. And by the way, Bitcoin ended up like $1,000 on the day. And at one point, it was down like $3,000. So a hugely volatile day in Bitcoin as well. But you can see that Bitcoin's kind of following those tech stocks. And if you guys remember the last video, I hadn't pulled up the tech stocks yet, but I said my guess is that they had a big rebound as well. And sure enough, they did. So Fed Open Market Committee, which sets interest rates, is meeting with expectations that it will not act at January meeting. That's this Wednesday, but will tee up the first multiple rate hike starting in March. In addition, the Fed is expected to wrap up its monthly asset purchase program that same month. I would be shocked if the Fed increased interest rates or did anything this Wednesday. But what we'll have to pay attention to is their language and how they kind of try to steer the market, use the psychological expectations policy that they have been using for so many years, so many decades, really. And are they going to be as hawkish? Are they going to turn more dovish? That's what we really got to pay attention to. I think that's the big storyline. At his post-meeting news conference, Powell also could signal when the Fed will start to unwind its mammoth balance sheet. If they do that, again, I think the market most likely would see that as hawkish, but we'll see. Goldman Sachs said over the weekend, and this may have triggered the immediate downturn when the market opened today. And that down, at one point, in fact, you know what? I'll bet you this is what happened, because Goldman Sachs came out over the weekend. I'm reading from the article now that it sees risks rising that the Fed could enact even more than a 4.25% rate point hikes this year. The firm also said the Fed might start running off the nearly $9 trillion in assets it is holding in July. Might start running off. Okay. So yeah, I'll bet you what happened is Goldman Sachs came out with this prediction that they could hike even more than 4 times in 2022. And they said the probability is higher that they'll now start quantitative tightening. And that's why this morning the market just completely fell out of bed. And then when it was down 1,100 points or whatever, we saw that I think the turnaround was right around 740 points. It was down, then kind of up a little bit, down even more, kind of bouncing all over the place, but really in the red. And then that predictor, and I don't know what that chart is. I don't know where Zero Hedge is getting it. I tried to find it and I could not find this chart. If anyone knows where they got this chart, let me know in the comments, please, so I can pull it up. But this is what we saw. Well, I'm sorry. This is not the intraday chart that I was referring to. The intraday chart's just like this, though. It starts here, it's kind of going up, and then midday it just crashes. That was the one that we used of Bitcoin earlier. That was this chart, excuse me. So I know this is a chart they may have made, but wherever they're getting this data, the rate hike odds, that's the chart I'd like to find. So you see this happening. Again, I don't no clue what time zone they're on here, but I don't think it's a time zone in the United States. So that's where you see this divergence. And this is when Bitcoin started to go up, when the market started to predict a lower number of interest rate hikes over 2022. And this is when those high-tech growth stocks started to rebound and go up, and the overall marketplace. And so another takeaway that I wanted to mention, let's get to a chart of the stock market going back 5 years, is, and we're going to look at the some technicals here as well. But one thing I wanted to mention is I think a lot of people that really don't understand macro, and even a lot of professional traders, they see this as, oh, it's great, they've got this short-term time horizon where they say, okay, well, the market's predicting that there's not as many rate hikes, therefore that's bullish for the stock market. Okay, I can buy that. But let's think about what that means long term for the stock market and what that means for the real economy. Like, if you ever had doubts that the stock market and the real economy is completely dependent upon the Fed, uh, you know, look no further for proof. It's right here. I think we can finally put that debate, not that we've really had it on this channel, but maybe in the mainstream media, they need to put that debate to bed. I don't think that is even in question anymore. I don't think you can, if you're being intellectually honest, I don't think you can make the claim that the real economy or the financial economy, the stock market, isn't completely built on the Fed's balance sheet. I mean, I think that argument's completely out the window. Obviously, on the Rebel Capitalist channel and the George Gammon channel, you guys know my view on that. I've been saying that the stock market and the real economy is completely dependent upon the Fed's balance sheet pretty much since 2019. But maybe in the mainstream media, the quote unquote adults in the room, we're having that conversation back and forth. But now, after what we've seen over the past 6 weeks or so, it just illustrates even further that this whole entire house of cards is just sitting precariously like an upside down pyramid on the Fed's balance sheet. And so so then the conclusion from kind of a newbie or a noob, as my buddy Meet Kevin says, the noob might say, oh, well, then that's no big deal because the Fed will always just come in and increase the size of its balance sheet. And then we've discovered the goose that lays the golden egg. We're all going to get rich. We found the miracle. We found the free lunch. All we have to do is have the Fed expand the balance sheet, just give stocks to everyone, and we're going to eradicate poverty. We're all going to get rich. Of course, you guys know how that story ends, and that's in Amerizuela or whatever that tweet was. That this is how that story ends. Right here, Amerizuela. So there is no free lunch. If man, it just further illustrates that the Fed is just in this impossible predicament. And if they're not now, they will be in my opinion, in the near future, where this is it, guys. This is it. And it's not just tapering stonks crash, it's tapering stonks real estate, the entire US economy collapses if they're doing this. Or the other option is, fine, we're just going to prop up the stock market and hold our nose, and we continue to see this consumer price inflation. But see, I have a hard time buying that because, again, it goes back to the politics that are involved that we really have to pay attention to. And you can say, oh, the Fed is just going to prop up the market. That's their number one priority. Yeah, I don't know. I think that they're more of a political institution than they would like us to believe, even though Powell's a Republican or whatever. So, yeah, I mean, for me, I see this, and it just, not that I needed someone to remind me, but it just reminds me of how precarious a situation, how precarious and how fragile the stock market is, and the real economy, and how just unbelievably dependent it is on the Fed's balance sheet, which at the end of the day, there's really no direct causal effect there. So what does that mean? That our entire economy and the entire stock market is completely held up by one thing and one thing only: confidence. That's it. And as you guys know, confidence can, it's like Fugazis. It doesn't exist. It's not real. Once that confidence goes, so goes the Fed put, so goes the government put. I don't think that's a matter of if, I think it's simply a matter of when. But let's dive into some further nuance. This is what I wanted to discuss with my buddy Patrick Ceresna tonight on the Rebel Capitalist Pro, which is my, if you guys, I don't really talk about it too much. You guys know I'm not that great of a salesman. But you guys should definitely check it out. It's the best investment website there is, period, bar none. I mean, you got to look at the pros that are involved. Lynn Alden, Chris McIntosh, Tony Greer, Patrick Stresna, Jason Hartman, Brent Johnson, Lynn Alden, did I say Lynn? And it's just, and I'm sure I'm forgetting someone, but we've got 6 incredible professionals, and then it's got research from Lynn Alden, Chris McIntosh, and it's just, you got to check it out. I think you can check it out at georgegammon.com/pro. But anyway, so what I want to talk to Patrick about tonight is this 6-month technical chart. Let's go over to the candlestick. The candlestick, I've, and this takes me way, way back. I read a book on candlestick charting, maybe 2002 or something. So I don't really get into the weeds here, but I do know that this could offer some support, this line right here. And we'll have to ask Patrick, how relevant that is to what happened to in today's action. We saw the volatility in the stock market. You'll notice that it went way down below that support line, then came right back up. And I was reading on Twitter that it did that with substantial volume. And that's a really, really, really big deal. When you have a reversal like this on a lot of volume, that means the bulls won, and the next day or this could reverse the trend and have this go back up. Now, again, I think that's all dependent upon what the Fed says Wednesday. But usually when you see a reversal in a trend, it's a candlestick that looks something like this on a lot of volume, which is what we saw today. Now, taking a step further back, I wanted to go to January of 2000, December of 2018, because that's when we saw the last taper tantrum. And want to point out that it wasn't just the stock market. I think what the Fed might have been even more concerned with back then were the credit markets. So if we remember back to that time, I think there was like a 2-month span where there was like no issuance of new corporate debt, which is I'm not an expert on corporate debt by any stretch, but I remember talking to Danielle DiMartino Booth back then, and she was saying that that's a very big deal, and that is a huge red flag for the Fed, even maybe more so than the stock market crashing as a result of quantitative tightening. So just to take a step further back, guys, remember that 2018 is when they started the last quantitative tightening cycle, if you want to call it that. And they did that for, taking it to December of right here, 2018. That's what we want to talk about. But they continued to taper until we got to the repo blow up of 2019. But what did they do? They stopped hiking interest rates. They went on a pause, and then they actually, in the middle of 2019, they started lowering interest rates. But this was right after we had that stock market crash, if you will, in 2018 December. And the Fed said, whoa, okay, no more rate hikes, no more rate hikes. So they started to get more dovish right there as a response to not only the stock market, but the credit market. So you can see the spread on junk debt, or this is corporate debt, excuse me, compared to I don't know if this is the 10-year Treasury. I believe this is the 10-year Treasury. So they're taking that 10-year Treasury as a benchmark, and then they're comparing it to the average interest rates on corporate debt. I thought this was junk debt. That's the chart I really wanted to see. But regardless, this goes to show you how the spreads were really increasing. And that's telling you the market is getting extremely worried about corporations, their ability to pay back their debt, and that's going to obviously affect the stock market. I remember talking to Lynn Alden at the last Rebel Capitalist Live, and this is the thing that she's focused on most is what's happening in the credit market, because she believes that the Fed will most likely continue on this path of tapering, hiking interest rates, and quantitative tightening if the credit markets obey. But if the credit markets get out of hand, then she says that's probably going to be the catalyst to them changing their tune and doing a 180, going from kind of a hawkish stance to more of a dovish stance. So, and then that in turn will play into the stock market, because if the bonds are decreasing in price, yields going up, the delta here is bigger, especially if treasuries, if 10-year yields are going down and corporate bond yields are going up, then that's I think a message that the corporate bond market is trying to send to the stock market, saying, hey, we got problems. And according to Lynn, she thinks the Fed that's what they're paying attention to the most. So my point there is that we've got to not only look at the stock market action and look at those technicals. We'll have to talk to Patrick about that. But we've also got to go back to the last tapering cycle in 2018, try to remember what happened there, try to figure out the differences and what can we learn going into the rest of 2022 and potentially the next quantitative tightening cycle. We will have to see if we even get there. Who knows? But so, not my point there is not only pay attention to the stock market if it's going down or up, but also I would pay attention to these spreads as well to try to get an additional indicator as to what the probability is that the Fed kind of stays course or they start to do that 180 with their narrative. All right, guys. So that was kind of the market summary and my thoughts. Want to encourage all of you to stand up and fight for freedom, liberty, free market capitalism. At the end of the day, it doesn't matter how much gold you've got, how much Bitcoin, real estate, what your stock portfolio is. If you ain't got freedom, you got nothing. So it's fascinating, and we always want to make prudent decisions when it comes to our financial future, but we've always got to remember that that's our number one priority. So guys, enjoy the rest of your evening, and we'll see you in the next video.